Welcome back to Pinkfish Inc. Today, I'm going to go over the double sevens example, and this will be part two, the algorithm, which is in strategy.py. In part two of this series, we're going to go over the notebook for this strategy. And in this notebook, we instantiate the strategy, we run the strategy, and then we analyze the strategy. So we'll open that up. I already have it open here. And so there's a short explanation of how the strategy works, which I went over last time. And we set the end date to now. Last time I talked about these options. And here we're setting the options that we want to pass into the strategy. Now, these are my optimized values. And I don't want to start with that because that's not how I start things off when I start analyzing these strategies. I start with these like vanilla defaults. So what I'm going to do is copy these into here, okay, and run with those. So these are a result of me running the optimizer and figuring out what values work best for me and what I was trying to achieve. But we're going to go with these. These are the defaults. So we pass these options in, and then we instantiate the strategy, run the strategy, and we get the trade log back and the daily balance back. I want to go ahead and run this so I can get it refreshed. So just say sell run all. Pretty fast at running through an algorithm, especially with a single stock like this. You saw it only took a couple seconds. So let's look at the trade log. We can see the entry date, the entry price, and the exit date and exit price, and then the profit loss points. So we got 6.5 points on this one and made $1,098 on this particular trade with 169 shares. And then you can see our cumulative total is moving up because these trades all happened this year and they were all successful. They all made money. So that's why our cumulative total keeps moving forward. The daily balance, this is the newest. So we're looking at the tail here, so we can see that we're all in cash now. So we haven't been in this trade for a few days. You can also look at the head if you want to, and like that. So looks like we're still in cash. We can lay out tail like this and then look at more data, so we can look like that. And now we can see where we were in the position here, and this is a high balance of that day, the low balance, and the closing balance. Okay, and then the number of shares we had and the cash we had on that particular day, and then the leverage on that particular day. And you can see here that at this point we have no shares, so we're in all cash. Okay, and then there's another trade that gets put on here. So you can follow through on the daily balance and follow the flow of this. And you can do the same thing with the trade log. If you want to look at more of the data in the trade log, you can set this to like 50. And this is you can look at more trades this way, and you can look at trades earlier on. If you can change this from tail to head, if you want to look at the first two. So that's how you can use these to look at the trade log and the daily balance. Let's move on down. Oh, after we run the strategy, we print the full statistics from the strategy, and there's a lot of statistics that get computed here. So you can go through and look at whatever you want to of this. You can see that the trading period here was 27 years. And the percent of the time in market was only 29.69%. So we're actually out of the market most of the time with this strategy. And we have the total number of trades, 276. And this trades about 10 times a year. So that's a little bit less than once a month. To be profitable with this strategy, you have to make these trades because it doesn't trade that often. And I'm guilty of that as well. Some days I get busy at work or whatever, and I forget, or I can't put the trade on for whatever reason. But these are somewhat rare, so you have to be vigilant and put these trades on or automate this in some way to be successful with it. This is a percentage-wise very profitable strategy. It has a win rate of 78%. With that, you have to make more money. You lose more money. Let's scroll down a little bit. You'll see this. I'm looking for the average loss per trade is $800, and the average profit for a winning trade is right above that. It's 500. So you need to win most of the time for the strategy to work, because when you lose more than you win per trade. So you need to have a higher winning percentage. That's the typically that's the way these mean reversion strategies play out. The opposite of that would be a long holding type strategy, like a trend following strategy. That one's not going to win very often, but the wins are going to be big and the losses are going to be smaller. So a lot of small losses and a few large wins with that type of strategy. This is the opposite of that. And you can look at the rest of these statistics. I'm going to scroll down here, and we're going to look at the comparison against the benchmark. So we run the benchmark, and with the benchmark, we want to set use adjusted to true, because that gives you a truer picture of if you were actually holding SPY, you would be benefiting from the dividend payments. So we want to set that use adjusted to true. That represents a dividend reinvestment. Now we plot the equity curves, and we see that the strategy in terms of dollar amount seems to underperform this benchmark. But we need to dig a little deeper, though, because if you look at these curves, they're quite different. And we'll see how that comes into play in just a minute. And that's a plot of all the trades. You can see we get out of trades when we get a big downturn. And so we don't do any trading during that time period. That's where the regime filter comes in. Okay, now let's look at some comparison between the strategy and the benchmark. We can see that the annual return rate is lower for the strategy, but look at the difference in drawdown. 14% drawdown versus 55% drawdown. Also, the Sharpe ratio, we have a higher Sharpe ratio for this one. Curiously, the Sorrento ratio is better for the benchmark. And here's a graphical representation of the trading strategy versus the benchmark. And then we're looking at the volatility graphs now of the strategy versus the benchmark. The benchmark here would be SPY, just holding the SPY, versus the 777 strategy. And with this, we see that the average volatility, and this is a 20-day annualized volatility, is quite a bit larger for SPY versus the strategy, more than twice as much average volatility. and then we have the median as well. And down here we have a box plot of this. And so this is a graphical representation of those numbers. And so this one right here is the 50th percentile, this yellow line across here. And we can see that it's lower for the strategy. And then the box represents this bottom part of the box. It's a 25, the first 25%, and this is the 75%. That means most of the volatility is going to fall. 75% of it's going to fall within the top of this box here. And you can see that it's lower for the strategy again versus the benchmark. I think the most significant thing is all these outliers, though. These are the outliers. They're a lot worse. They're a lot further away from the mean than for the strategy. And there's another graph of this here that's showing, this is just a graph of the volatility. And so we have we have SPY, the benchmark, and we can see these massive spikes in volatility here. And we don't see that in the strategy. We see a volatility that's sort of follows the benchmark until the benchmark gets really bad, and then SPY, because it has a regime filter, just gets out of that and doesn't involve itself in that massive volatility. If you want to read more about this box plot, there's a good website for this from the Towards Data Science website, Understanding Box Plots. And I will post the URL to this if you want to go and read more about how these box plots work. I have 3 other graphs here. It's just showing another representation of the returns of the strategy versus the benchmark. This shows the relative strength of the strategy versus the benchmark. And over 1, then the strategy is outperforming the benchmark. You can see that it's outperformed. It's actually, of late, it's underperformed the benchmark. So, yeah. Now, this is on returns only. Okay, that's all we're looking at here is returns. On the correlation, we have the strategy sometimes being highly correlated, as you would expect, and then other times it's not correlated at all, and that would be the times where regime filter is kicked in. The next part is the Kelly Criterion. Kelly Criterion is a way to size your margin, to decide how much leverage you want to use. So we ran this strategy with no leverage, but that's not if you're able to get access to margin, then you should be using margin when it makes sense. And so the question is, does it make sense? And that's what Kelly Criterion tries to answer for you. So using the Sharpe ratio, we can go through and calculate very easily the how much we should be leveraging. So the Kelly Criterion, you can look up videos on that explain it, but basically the optimal risk target for Kelly Criterion is the Sharpe ratio. So you can see that it's 0.77, and that's the same as the Sharpe ratio. Then using that information, we can calculate, this would be the this aggressive leverage, I'm calling it. That's going to give you your maximum profit. So if you use a leverage of 4.48, you would get maximum profit. Now, no professional, I don't believe, would recommend using this. And they usually use what's called half Kelly, and that's what this moderate leverage is. So that's half Kelly. You can just see it's 4.48 divided by 2. And I also have another calculation that I invented called a conservative leverage, and that puts it at 2.12. And to learn more about these, you can go to the Pinkfish documentation and look up Kelly Criterion. Okay, and it will go through and explain these things to you, how it works. And so the conservative leverage it's basically the half Kelly or the moderate leverage, but it takes it calculates a minimum for the Sharpe ratio using the Sharpe ratio minus 3 standard deviations of the Sharpe ratio, and so then it uses that, and you get a lower number. Obviously, it's going to be a lower number. If you want to dig deeper into this, you can look at the source code for this and how this is computed. The actual calculation for this stuff is over in the statistics.py file. So let's go back to the strategy again, and let's apply this leverage. And instead of 2.12, I'm just going to set it to a round figure. I'm just going to set it to 2, okay? So we can see how this impacts things by setting this to 2. Sell, run all. That was fast. So look what's happened. So now our strategy is vastly outperforming the benchmark. But let's see what happened to the other stuff. So our strategy now is giving us a 15% annualized return a year. The drawdown has doubled from 14 to 28%, but it's still not bad. It's still far better, almost still twice as less than the benchmark. The Sharpe ratio is unaffected by the margin, so it stays the same. And you can see that we've increased the volatility. It's starting to look a lot like the benchmark. This part is actually even bigger, but not that by much. So this is looking more similar to that one. And we have some of the spiky stuff now in the volatility for this. So anyway, that in my own trading, I use 2x leverage for this strategy. It takes advantage of that low drawdown, and yep, that does it for part 2. And then in part 3, we'll go over the optimizer.